Most Canadians are sitting on money right now that's working against them. And I don't mean your stocks or your house. I mean the cash parked in a savings account earning maybe 2%, while the Government of Canada 2-year benchmark bonds are yielding around 2.8%, with similar safety and better liquidity. And if you're waiting for real estate instead, in Toronto and Vancouver, the minimum down payment now runs over 4 times the typical yearly income. So that's not really a plan either. I'm going to show you exactly why bonds are the most ignored tool in a Canadian investor's toolkit. And once you have this set up inside a TFSA or RRSP, the after-tax math changes completely. This works at any age, and it starts with understanding what you're actually invested in right now. Hi, Kane here. I'm a theatre grad that started with nothing. 20 years later, I own properties throughout Ontario. Be sure to watch my biography video to see my struggles. Moreover, read the description below to see the references pulled for this video. If there are any discrepancies, please let me know. The information provided here are for educational purposes only. If you're going to invest, be sure to speak to a licensed professional. Without further ado, let's get started. For most Canadians, the TSX looks like a diversified portfolio, but about 40% of it is financials and energy. So if you own a Canadian index fund, you're not diversified in any real sense. You're betting that the big 6 banks stay healthy and that oil prices don't collapse. And if both of those things go sideways at the same time, your diversified portfolio drops hard and fast. That's exactly what happened in early 2020. Canadian bank stocks fell sharply. The TSX dropped harder than the S&P 500. And a lot of Canadians who thought they'd spread their risk around found out only they hadn't. The TSX financial sector isn't just TD and RBC. It's also Manulife, Sun Life, and a cluster of insurance companies. Suncor, CNQ, and Cenovus are on top of that. So when you buy a Canadian index fund, you're not buying a slice of the whole company. You're buying a sector bet that happens to come with a few tech and consumer stocks stapled to the side. Real estate looks like the obvious way out of this, right? Except the numbers don't support it. In Ottawa, only about 1 in 4 homes for sale is attainable on a medium income. And in Toronto or Vancouver, that drops to roughly 1 in 7. In Calgary, mortgage carrying costs hit 34.5% of median income in 2023, and that's before you saved for the down payment. So, you've got stock market leading hard on 2 sectors, and a housing market that's priced out a large chunk of buyers. And most people responded by parking their cash in a savings account that's paying less than inflation. That's not a strategy, that's just losing money slowly. Now, 2022 is worth pausing on because it's complicated, something a lot of investors assumed. The TSX fell 5.8% that year, but Canadian bonds dropped 11.8%, which wasn't supposed to happen, and it shook people's confidence in fixed income as a cushion. We'll get into exactly why that happened and what to do about it, but in short version is that it had everything to do with how fast the Bank of Canada raised rates, and it affected long-term bonds far more than short-term ones. Concentration risk in the TSX isn't a theory or a worst-case scenario. It shows up in the index composition data, and it's the reason that owning something outside of bank earnings and oil prices actually matters. A provincial bond from Ontario doesn't care what TD reported last quarter. A Government of Canada bond maturing in 2 years pays its coupon whether Suncor is up or down 20%. Once you see the TDX for what it actually is, a 2-sector bet with some padding around it, the case for bonds is it about being conservative or playing it safe near retirement. It's a basic diversification question, and understanding how a bond actually pays you is where that answer starts. A bond is a loan you make to the government or a corporation, and the terms are fixed before you hand over $1. Take a $1,000 Government of Canada bond with 4% coupon and a 5-year maturity. What that means in practice is the government sends you $40 a year, split into 2 payments of $20 every 6 months, and when the 5 years are up, you get your original $1,000 back. You're lending money to the federal government. They're paying you a fixed rate to use it, and the whole thing is spelled out in a contract before you put in a single dollar. the payment can't get cut. A company's board can vote to reduce or cancel a dividend anytime they want. But a bond coupon doesn't work that way. The government of Canada has never defaulted on a domestic bond, so when that payment date hits, the money moves. That's a level of income certainty you don't get from stocks. Most Canadians already know what a GIC is, so comparing the two makes sense here. A GIC also pays a fixed rate and gives you your principal back at the end. But if you need the money early, you're usually stuck or paying a penalty to get out. A bond trades the secondary market, so you can sell it before maturity if you need to, and the price you get depends on where interest rates are sitting at the moment. That's where yield to maturity comes in, and it matters more than a coupon rate alone because YTM accounts for any capital gain or loss you'd realize if you hold the bond to maturity. If you buy a bond at a premium, meaning you pay more than face value, your YTM is actually lower than your coupon. So the sticker rate can mislead you if you don't look at the full picture. When the Bank of Canada raises rates, existing bonds with lower coupons becomes less attractive to buyers, so their price drops. When rates fall, those same bonds become more attractive and their price goes up. This is called duration risk, and a 2-year Government of Canada bond barely moves when rates shift by a quarter point, while a 30-year bond can swing several percentage points on that exact same move. Provincial bonds from Ontario or BC work exactly the same way. They put a slightly higher coupon than federal bonds because they're marginally more credit risk priced in. Provinces collect steady tax revenue, and they use bond proceeds to fund things like schools and hospitals, so nobody's actually betting Ontario defaults. But the market still prices in a small spread because a province isn't the federal government. Corporate bonds push that yield even higher because now you're taking on real credit risk, and if the company can't make its payments, corporate bondholders are in the payout line, and it's a long line. That spread between bond types is actually something you can put to work deliberately. And the way most people do it is by staggering when their bond matures rather than betting on everything on one maturity date. A bond ladder is how you put that staggering into practice. And once you see how it works, it's hard to go back to holding everything in one position. Say you buy a 1-year provincial bond, 3-year Government of Canada bond, and a 5-year bond at the same time. When the 1 year matures, you take that provincial and roll it into a new 5-year bond at whatever rate is available then, and you keep going. If rates go up, you're reinvested at this new rate. If rates drop, you've still got your longer bonds locked in at the old rates. You're not trying to time everything, you're just staggering when the money comes back to you. In 2022, rate cycle shows exactly why this matters. The Bank of Canada moved its policy rate from 0.25 at the start of 2022 all the way up to 4.25% by the end of the year, one of the fastest tightening cycles in history. Canadian bonds dropped 11.8% over that year because existing bond prices fell as new bonds came to market paying higher coupons. Anyone holding a long duration bond ETF felt that across their whole position. Someone with a ladder, though, had short-term bonds maturing throughout the year and reinvested the cash at the new higher rates. So the pain stayed contained to the longer end, not the whole thing. Real return bonds, or RRBs, add another layer on top of this. These are Government of Canada bonds where the principal adjusts to CPI, so if inflation runs at 4%, your principal grows at 4%, and your coupon gets calculated on that larger number. You collect the full inflation adjustment at maturity, but the CRA treats that annual increase to your principal as taxable income in the year it accrues, even though you haven't received $1 of it yet. That's a real cash flow problem if you are holding RRBs outside of a registered account. So they work best inside a TFSA or RRSP when that annual gross up doesn't create a tax bill on money you haven't touched. Speaking of the TFSA, bond interest is normally taxed as regular income at your full marginal rate. In Ontario, at $80,000 of income, that's around 31%. Put those same bonds inside a TFSA and the interest compounds completely tax-free. over 10 years, that gap in after-tax return gets wide enough to matter a lot. For the practical side, you can build a ladder using provincial bonds through a safe directed account on Questrade or Wealthsimple. If you want something simpler, ZAG, BMO, or VAB from Vanguard both track the broad Canadian investment grade bond market, meaning they only hold debt rated BBB or higher across hundreds of bonds, and both carry a management fee of 0.2% per year. You can hold them side by side, one short term and one mid-term, and approximate the latter effect without buying the individual bonds one at a time. Getting that first position open is simpler than most people expect. Trade are both free and open, have no account minimums, and let you buy ETFs commission free, so either one works as your starting point. Wealthsimple Trade runs clearer on mobile if you're starting from scratch, and Questrade gives you more control over order types once you want to get more precise. Once you're in, make sure you open a TFSA, not a cash account. Bond interest is the safest tax-efficient form of investment income you can earn because the CRA taxes it at your full marginal rate, unlike Canadian dividends, which gets the dividend tax. In a cash account of $80,000 of income in Ontario, you're handing back roughly 31 cents on every dollar your bond earns. Sheltering that inside a TFSA means the interest compounds without a tax bill attached to it. If you've never contributed to the TFSA and you're over 18, your accumulative room going into 2026 sits at $109,000. So there's almost certainly space to put your entire bond collection in there without getting close to the limit. The next decision is which ETF to buy, and this is where most people freeze up and do nothing for 6 months. ZAG from BMO and VAB from Vanguard are both aggregated bond ETFs, meaning they each hold a mix of Government of Canada bonds, provincial bonds, and investment-grade corporate bonds across different maturities. The difference between them is small enough that it shouldn't stop you from starting. Search the ticker in the app, select the ETF, and put in a buy order for how many units you want. Both ETFs trade in the $14 to $16 range per unit right now, so a few $100s gets you started and you add to it over time. For allocation, a starting point Canadian financial planners have used for some time is to hold your age as a rough percentage in bonds. So if you're 40, that's around 40% bonds and 60% equities. That's not a rule. It's not a starting point, and if you got a long time horizon, you might run lower. If you're within 10 years of a big expense like retirement or a property purchase, you might want to push it higher. Once you have your first position, check the Bank of Canada's website occasionally. They publish bond yields updated daily, and when you're on the page, look specifically for the mid-market closing yields, which is the number that actually reflects where the market settled at the end of the trading day. It takes about 2 minutes to see where your yield curve is sitting and where the short-term rates are still above long-term rates. On the RRSP side, if you're in a high-income year with contribution room available, bonds inside an RRSP lets you deduct the contribution now. Collect the coupon payments without any annual tax hit and defer the tax on that interest until you withdraw in retirement when your marginal rate may be lower. Set a calendar reminder to reinvest your distributions every quarter, and that's really the whole system running. This is just a quick overview. Speak to your accountant or lawyer for more details. The system running on its own is the goal, but it only works if you've actually built it. You've got a stock market that's 60% banks and energy, a housing market that's priced out most buyers under 40, and a savings account paying less than a short-term Government of Canada bond right now. That's not bad luck. That's just the Canadian investing setup most people are working with, and ignoring it means your entire financial future rides on interest rate cycles and the price of a barrel of oil. Open a TFSA on Questrade or Wealthsimple Trade and watch your duration risk. When the next rate cycle hits the way it did in 2022, you'll know whether your ladder is short enough to ride it out or whether you're holding long-term bonds that are about to drop hard. If you enjoyed this video, be sure to watch my next one on mortgage investment corporations that can put passive income into your bank account while you sleep. Thanks for watching.